Hello, everyone. Hello. How's everybody doing today? Hello there. I had to mute the screen. How are you all doing today? How is everyone's afternoon today? As you come in, say hello. As you come in, say hello to let me know that you can hear and see me clearly. As you come in, say hello so that I will know that you can hear and see me clearly. I hope you all are having a great afternoon today. Well, today, you guys, I just came just to share a few nuggets with you all from Integrate and Prosper, my live series, but I wanted to share some information that has been brought to my attention about a few clients that I've just recently been blessed with. They had some situations that came up. And so I wanted to introduce some things to you all today. So that's why I'm here today, you guys. I am Dr. Shullundia, and today we'll be discussing the 5 audit triggers to avoid when filing taxes. Yes, there are 5. Well, there's more than 5, but today I'll be going over the main 5 that my clients have encountered before they came to me. Some things that come up, and I see it. I see it quite frequently. These 5 audit triggers that actually you want to avoid when filing a tax return. So let me ask you all this. Are you all ready to keep the IRS off your back? Are you ready? Because if you are ready, these things that we're going to discuss today, these are going to help you keep them off your back, okay? So we're going to learn the top 5 triggers to avoid when filing a tax return and to protect your hard-earned money. That's what we want. We want to protect your hard-earned money. So thank you all for joining me today. Again, I'm Dr. Shullundia, and we're going to go over some great insights that you need to know to stay audit free. Okay. It's about staying audit free. So, again, hello, everyone. I'm Dr. Shalani. I'm your business tax advisor at the CEO Tax and Accounting Firm. And today we'll be deep diving into 5 audit triggers that you want to avoid when filing your tax as well. The first one we're going to go ahead and jump right in because I know it's lunchtime and I want you to go ahead and enjoy your lunch, but I wanted to give you a little tax tip so you can stay audit free. Yes, a little tax tips today so you can stay audit free. So the first thing we're going to go over today is inconsistent income reporting. That's number one. That's the number one audit trigger when filing your taxes. You want to avoid this number one, inconsistent income reporting. Yes, inconsistent income reporting. So let me explain what is inconsistent income reporting. So inconsistent income reporting actually is definitely self-explanatory. Basically, when the IRS compares your income across all forms of income that was submitted, okay, things that you submitted, as well as the W-2s, the 1099s, whatever income that was reported to them, these are the things that they're going to be reviewing. They're going to review what you submitted against what was submitted to them. And a lot of you may or may not know, but when you receive W-2 wages, when you receive your 1099 forms, whatever forms you receive from your employer or from a contractor that you may have done business with, the IRS get the same information. Some of you may or may not know that. And so what happens is this: when they get the information and then you don't report it, this actually starts a trigger. This actually yeah, it starts a trigger. So that's something you want to think about. Okay. So if you're getting information, you're getting wages, 1099, W-2s, whatever you may be getting, think about that. Okay. Because if you got them, that means the IRS got them as well. So they know what you made, right? But most of the times, most of you may try not to report it, but that actually triggers an audit. And that's what you don't want to do. Most of the times, what you do as an individual, you try to hold off on reporting that information, but the IRS already know you made it. So they know you got that income. They know you made those wages. And then sooner or later, before the year is out, it may not be their current year, it may be the following year, but you'll receive this big white envelope in the mail that's basically showing you that, yeah, we know you made these wages, but you didn't report it. So what they do, they adjust it. They adjust it for you. They most of the time they amend the return for you and say you owe us this. But when they do it, they're going to add interest to it and a penalty to it, right? So I'm going over this to you at this time because what's coming up? Can anybody tell me what's coming up? October the 15th is the late filing date, right? We are in August now. So October the 15th is the late file. So you file for an extension this year, this tax season for this year, 2024. That date is coming up for October 15th. So I want you to know in advance, okay, in advance that tax season is basically is winding down. It's winding down. We are the last, almost the last quarter of the year. We're in the third quarter. And I wanted to bring this to you, these triggers, because for those who have not filed, you still got time. You got until October 15th if you file for an extension, right? But there are some triggers that you may need to think about before you complete their return. These are some things if you want to avoid an audit, you need to be mindful of these things. I'm going over the top 5 that I've been experiencing with clients that they've come to me and brought to me from previous people doing their returns. These are some audit triggers that they've been experiencing. These are the top 5. Okay. The first one I just went over was inconsistent income reporting. And that's when I said that when you submit or you don't submit income that was actually reported already to the IRS, so they know you made those wages, but you didn't report it, those inconsistencies, that triggers an audit. For example, if you reported $80,000 on your tax return, but your 1099 say 95,000. Come on, that's a discrepancy, and that could actually trigger an audit. Okay, that can actually trigger an audit. So failure to report all the freelance income that you have made and monthly resources, especially if clients have reported those payments to the IRS. Come on, so if you got an employee or a contract that's reported saying you made this, even if you're a freelancer, I need you to remember, even if you're a freelancer, you have to report that income. And they are getting stricter and more stricter when it comes down to reporting the freelance income, even through Cash App, PayPal, Zulu, all these Zelle, I'm sorry, all these other different avenues that you can report. So it's best to go ahead and report that income because the IRS gonna know. They winding down, they buckling down on a lot of things now because I know a lot of times, no, back in the day you can get away with not filing that extra income. But now they're buckling down their Zelle, everybody, Cash Out, PayPal, they're having to report these things now. So it has to be a certain amount though. But just stay abreast on what's going on in the industry because you need to know these things, okay? These are some things that you need to know. So as you come in, say hello, so I know that you're there. But so that was number one, inconsistent income reporting. And how can you avoid this? I'm gonna go over a few things, a few tips to show you how can do, because I don't want to just tell you what to not to do, but then don't tell you how to avoid it. So a few tips that you can do is double check all your income forms for accurate before filing. So before you filing, like, because you got into April 15th during normal tax season, right? You know, we start at the beginning of the year to April 15th. That's the normal compliance time, right? So when you do that during that time, make sure you double check all your forms, okay? Double check your form for accuracy before filing. Okay, you may have to hold off because you have like, because as an employer and also contractors, we have a certain time that we have to get those forms out to you to report. So we have a deadline. So by us having a deadline, that means that you have the opportunity to wait on that information. And you got plenty of time until April 15th to file your return. So don't be so quick to jump and file if you don't have to. Wait to make sure you got all your documentation. Because again, remember, with inconsistent reporting is a red, it actually triggers a red flag. It triggers an audit. Okay, so make sure we got all those things in place. Using reliable accounting software to track all your sources throughout the year. That's another way that you're able to actually avoid these audits. Reconciling your wages through like your bank deposits and your financial statements and things like that. That is another way that you can actually avoid triggers when it comes down to reporting inconsistent income. And the fourth thing is make sure you consult a tax professional to ensure that all your income is accurately reported and nothing is missing. Okay. So that was number one, inconsistent income reporting. Okay. So I hope this information was good. So if you have any questions about that, just let me know. But that was number one. That was one of the main triggers that a lot of people actually become audited for because they do not report their income accurately. Okay. The second one, what's the second trigger? The second trigger is high deductions. Yes, high deductions. So we're not going to be long on this. So the second, high deduction. So when I say high deductions, claiming unusual high deductions relative to your income. It can be red flag for the IRS. Okay, now this includes deductions for your home office, travel, meals, and entertainment. You got to be careful because they had cut off their entertainment, so you got to be careful in reporting certain things. You got to be mindful because these things can actually trigger an audit. Okay. So an example, claiming your home office deduction that's unusual lower for your type of business. Okay. Like a photographer claiming an entire house as a studio. If it's not a business studio, but it's a house, because think about it. Everybody can Google your address. They'll see that it's a normal house, right? But you're claiming the entire house. If your house is 2,000 square foot and you claiming that whole 2,000 square foot as your studio or as your business office, that may trigger an audit. Okay. Excessive travels, entertainment expenses that don't correlate with your business income or your industry norms. This can trigger an audit. So let me give you a few things that can actually avoid that. Keep meticulous records, okay, for all deductions claims. Keep good records for all deductions claims. It can actually back you up. Okay, the second thing is ensure your deductions are reasonable and justifiable within the industry norms. If you're a photographer, make sure those deductions are within that norm. Okay, don't be having those high deduction that like, okay, you spend all that money on a camera, or you like again that house expense deduction. You claiming the whole 2,000 square foot of your home, and actually you only use 200 square foot, be careful. These things can actually trigger an audit because they know the normacy of your industry. They understand that. So when you go outside of that normacy, that can actually trigger an audit. But just make sure you keep good records in case if you are using more than normal, keep good records, okay? So keep good records, ensure your deductions are reasonable, understand the specific requirements for the deductions, okay? Like the percentage of your home used exclusively for business to qualify for home office deduction. So there's a certain percentage square footage that you need to do to get that accurate number. Make sure you're doing it the right way. You may have to contact who? A consultant or a tax professional, someone to help validate your deduction before filing. Okay. So make sure you do all these things before filing. Make sure that you consult with a tax professional or someone else that actually know the exact ways to measure your property or your studio or your office space to make sure you're getting that deduction reported properly because they know how to do it. The IRS knows, so they know exactly the right way to do it. So if they feel like it's out of normalcy, that can trigger an audit. Okay. So we said the first thing was what was the first one we mentioned? The first one was inconsistent income reporting. The second was high deduction. And we're on the third one now. The third one is cash businesses. Cash businesses. That is the third audit trigger. If you have a cash business, be very, very careful how you report your income, okay? Because that is an audit trigger. The IRS looks at this. So if your business deals primarily with cash, the IRS looks more closely and pay more attention due to the potential of you can actually underreport your income. They pay very, very close attention to this. Hello, as you come in, say hello so I can know that you can hear and see me clearly. But this is common in the industries, okay, like restaurants, the beauty industry, bars, small retail shops. The IRS know these are like the things that most of the time people don't report all of their income. So these cash business can actually trigger an audit. So be careful. So some things or some ways that you may be able to avoid being audited with these cash businesses is maintain detailed, accurate records. Okay. Make sure you maintain detailed, accurate records for all your cash transactions. Okay. That's one way. The second way is use point of sale, a point of sale system. Okay. We know what a point of sale system like. That's the cash register or the one that has like a lot of times they have the iPads now with the different systems, a POS system, okay, a point of sale system. Have some way that you can keep accurate records because you can do with the software these days. You can go on those registers and click your total for the day and download different things. That's there for a reason, you guys. This that'll help you, especially if you got a cash business, having some form of normalcy to make sure that you are reporting your income properly. That point of sales cash registry is what you need. Okay, it actually provides evidence of your income. So if the IRS try to audit you about saying no, that's not the correct income you're reporting. Yes, it is because I got records. You can go on that POS system and pull a monthly statement on what you made for the month. And guess what? If you have to do it for the year, you can go on that POS system and put it up for 12 months. And so that's your accurate reporting. That's the accuracy of you reporting your income properly. A lot of times you have to make sure you back yourself up because if the type of business you're in is a cash business, that business may actually be something that may trigger an audit. Okay. So think about that. Is there a way you can report that income and save it? Whereas if you are audited, you can pull up that system, because if you're a cash business and you sitting there and you looking like you putting it all in your pocket. And then another thing, if you have a cash business, you don't have a business bank account, that's another no-no. If you have a business, you should have a business bank account. Do not mix and mingle that money with your personal income, okay? Because it's going to be hard for you to decipher when the IRS audits you and they say we need proof that this was actually from your business. Or they may say we believe based on your industry norms, you should have made more than this, because if somebody else doing the same type of business in your area and they look at what they're reporting and then they're looking at what you report, and those numbers are not adding up, they can actually trigger an audit. Okay. So I need you to be very, very mindful, very, very mindful of that. Okay. So maintain good records. Make sure that you make your deposits regularly. If you have an in-town bank where you can go and do nightly deposits after you close shop, go and make those nightly deposits. I remember when I was a branch manager for several years, that every morning when we came in, we poured that nightly deposit. Okay, we poured that nightly deposit, and what we did before we started our day at the branch, we recorded, we made those deposits to those customers' accounts. Okay, because we knew that was very, very important. We did that before we did anything else. We made sure we logged those deposits the first thing that morning. Why? Because you want to show accurate reporting. If they want to pull your bank statements or what have you, you got accurate reporting. Say, yeah, I made this, but I made those deposits. Making those deposits are also a way to back you up. Okay. So conduct periodic audits of your own records to ensure that everything matches up. Make sure you reconcile those bank statements when you have a business bank account. Make sure you reconcile those bank statements monthly. Go in and check, cross check. You know, if you wrote in your book saying you made $100 that day, make sure your bank statement for that next business day that says that you reported that you deposited $100 in that business bank account. Correlate it, cross reference it. Okay, that's what I'm saying. Cross reference your numbers. So if they ever do come and audit you, you're able to show proof that no, I made this amount of money. I don't know what Jay is making over there across the street, but this is what I made. Okay, so that's a one way to keep update with that. So that was number 3. Okay, cash businesses. Number 4, the next 4, the fourth thing that can actually trigger an audit is claiming business losses year after year. You guys, this is something else. When you claim business losses year after year, I need you to think about this. So you're Jane, and every year you file in a business and you file your tax return, right? And every year you are in the red, and you've been doing this for 5 years. The IRS frowns on this. They frowns on this. They want to know, if you are in business, you should be in business to make money, right? You should be in business to make money. So what you should be doing, you should be reporting that you made, even if it's $1, okay? You should have made some money within that last 5 years. So now at this point, the IRS saying this is not a business. I'm sorry, honey, but we got to shut this down. This is no longer a business. This is what? A hobby. So yeah, they consider it to be a hobby. After 3 years, like especially you know what, over 5 years, like you really triggering the audit now, because they're like, you know what? Sooner or later you're gonna receive a letter saying, you know what, you're not making any money. And to them, they're looking like, you ain't making no money, it's time to shut it down. Okay. So that's what the IRS looks at. So their fourth thing is claiming business losses year after year. Think about that. Consistent businesses can lead, consistent business losses can actually lead to an IRS to question your business legitimacy. Okay, especially if your business reports losses for multiple consecutive years, like I said, right? The IRS may suspect that the business is a hobby rather than a legitimate profit-seeking enterprise. They frown on that. Okay, for example, you report losses for 3 consecutive years without a clear plan for profitability, for a clear plan of profitability. That's a red flag. Claiming personal expenses as business losses to reduce taxable income, they frown on that. Okay. The IRS frown on all of this. So what can you do to make sure you're not triggering an audit, even if you're claiming business losses year after year? Ensure your business expenses are necessary and ordinary. That's what? Section 162A. Code section 162A, making sure your business expenses are necessary and ordinary. Okay. Keep personal and business expenses separate to avoid these confusions. Okay. Keep your personal and your business separate to avoid this confusion, because it's definitely can be a confusion if they audit you and you got your personal and your business. Remember in step 3, we talked about cash business, right? Make sure you have a business bank account so you can keep your cash separate from your business and your personal. Okay. Develop a clear business plan aimed to achieving profitability. So if you notice in the last few years, like I'm not making any money, okay, make sure you got a business plan in place. If they contact you and reach out to you, say, what do you plan on doing differently next year? Because you might need to shut this down because this is not a profitable business. And guess what? This is now a hobby. This is what the IRS is looking at. It is now a hobby. Okay. So the last thing is what you may need to do. As normal, you may need to contact a tax professional to understand the IRS guidelines for business losses because you may not know if you've been doing your taxes on your own, you're not having a professional to consult you on these things or advising you, you don't have a CPA or no one advising you on these things. You just feel like, you know what, I'm gonna do it a loss every year. That's not good. The IRS frowns on that, okay? So that was number 4. When your company keep claiming business losses year after year. Okay. And number 5, you guys, this is the last one. We're not going to be before you long today. Number 5 is what? Rounding numbers. Oh my gosh, they definitely frown on it. And a lot of people don't understand why they frown because they know you're not telling the truth about your numbers. Now, there's some things maybe rounded, like if you have a consulting or a program or something you're doing, most of the time they got round numbers right. But with every expense that you have reported, on their Schedule C or their what you call it, the if you're an S corp or if you're a C corp, remember if you're reporting these expenses, all your numbers should not be rounded. The IRS frowns, and this is the 5th audit trigger, rounded numbers. So rounding your figures can look suspicious to the IRS, okay? They actually prefer exact numbers. Why? Because rounding may suggest estimates rather than accurate report. Okay, I'm gonna say that again. The IRS prefer you to use the exact number because rounding numbers may suggest estimations rather than the accurate reporting. They don't want you to do estimations. They don't want you to do that. They don't want you to do, yeah, they don't want you to do estimates. They want you to do accurate reporting. Think about that. So let me give you an example. When I say exact numbers, you rounded off, you reported $5,000, right? Instead of reporting that the expense was actually $5,123, you said you reported on your return $5,000 as a business expense. So rounding every expense to the nearest hundred of thousands, such as 1,000 instead of $987.50. Come on, think about that. Now, if you got a software program, because I do understand there are some softwares out there, that's why you have to be very careful as well. Whatever software, if you are a tax professional, what software are you using? Or if you're doing your own taxes, what software are you using? All softwares are not reported equal. They're not reported equal. Your software plays a good role as well as in how your numbers are showing up on your return. Always report. I'm gonna give you this example and this tip. Always report exact figures as they appear in your records. If you spend $523.83, put that on that as an expense. $523.87. Don't put $550. Don't round it off. Don't go back and say $500. Whatever the exact number is, remember, you're trying to avoid triggering audits. We're on number 5, which is the 5th audit trigger when we're reporting round numbers. Do not report round numbers, okay? Report the exact expense number, whatever that number may be. Report that exact number. Use precise accounting software to avoid rounding errors. Again, like I just said, all software is not reported equal. It's not. So make sure you have a good software. And I am a retail software. I am a software reseller as well. So if you need software, reach out to me, and then also in the comments say software. If you need a legitimate software, because all software is not reported equal. If you buy it offline, or you may be going to Office Depot buying basic software, that may not be what you need. You may need a professional software program that can actually give you the right accuracy that you need to report without triggering an audit. Okay, think about that. Double check your calculations before filing to ensure precision. Make sure that you have the right numbers reporting. Okay. Do y'all have any questions? Do you all have any questions for me? I'm gonna do a quick review right quick over all 5 of them. What was number 1? Number 1 was inconsistent. Number 1, Inconsistent income reporting. Okay, we're about to close this out. We're about to shut this down. Like I said, I know this is your lunchtime, and I don't want to hold you long, but we're gonna go over a quick overview, real quick, over all 5 of the audit triggers that you want to avoid when filing your taxes. Number 1 is inconsistent income reporting. Okay. Number 2 is high deductions. Think about that. Number 2 is high deductions. We want to make sure our deductions are not too high. Okay. Number 3 is cash businesses. If you have a cash business, make sure that you are reporting that income accurately. Okay, you got the right software you need, you got everything you need. Okay, number 4, claiming business losses year after year after year. The IRS frowns on that. Now they're saying, guess what? If you are making losses year after year after year, you've been in business this long, you now have a hobby. If it's not profitable, it's not a business. You now have a hobby. So think about that. Okay. And the fifth, the final thing was rounding numbers. Make sure that you are not reporting round numbers. You are reporting exact numbers. Okay. Do you guys have any questions for me? I'm about to move on from here, but I wanted to come and share these 5 audit triggers with you because I've been seeing this happen quite often with a lot of even tax professionals that may be new in the industry. They're doing these things and causing clients to get audited. Okay. So make sure that you are doing what you need to do. And there's a difference also, you guys, from an audit than from a verification process. A lot of times you may get a letter from the IRS that says, we need you to verify. That does not mean you're being audited. A lot of clients freak out. I'm being audited. I'm being audited. And no, you're not. Okay. They do have verification processes that they put so many people through. Okay. You may be like triggered or you may be picked for a verification process. That means they want to verify you are who you are. You are a legitimate person with all this malfeasance and everything going on in the world today. They want to make sure you are a legitimate U.S. citizen. Okay. So they want to make sure that you ain't out here filing something and doing something illegitimate, right? So what they do is they want to verify you. So they may ask you to verify this. They may say, call this number to verify this or submit this. Okay, that's a verification process. That is not the same as an audit when they're trying to audit your whole business. That's totally different. Okay, so those are 2 different scenarios. So think about that. Don't get so uptight or like eager when you receive a letter saying we need you to verify who you are or call this number to verify. Okay, if your return was done by a professional, just reach out to them and say I received this letter. Explain it to me. They will let you know. That does not mean that you're being audited. They just want to verify. They may want to verify your W-2. They may want to verify your 1099. They may want to verify you are who you say you are. Okay. So, and again, this happens also, you guys, when a lot of times when you have dependents and you start a lot of people, that's another trigger too. That's this is a bonus. You may get audited or a trigger may happen when you started using different dependents on your return. Be mindful. Keep the same dependents. If they're your dependents, use those same dependents over and over and over. Jane Blow over there shouldn't be using your dependents next year. And then you decide you want to use something else. It's like you got these dependents moving to and fro. That's an audit. That's a trigger. That's a trigger that makes the IRS feel like you're doing something illegitimate, like something ain't right. Okay. So that was just a bonus with the dependent information. But just make sure, you guys, those were the 5 audit triggers that I just went over. If you missed it, go back and hit hashtag replay if you go back and watch it on the replay. But if you are live with me today, hit hashtag live to let me know that you're here watching this live session with me today. We went over the 5 audit triggers that you want to avoid, okay? That you want to avoid when it comes down to filing your tax, okay? So I'm not going to be before you long, you guys. So if you have any questions, put them in the comment section and I'll be more than happy to go back and look over those. But I also want to let you all know that by avoiding these triggers, you can keep your tax filing safe from scrutiny. That's what you want. Okay. Now, if you want to dive deeper, I want to share something with you all. If you want to dive deeper and unlock new revenue streams, that means if you are a business, okay, I want to invite you to my new Revenue Diversification Academy. Okay. What is that? That is a game changer for if you're a business owner or financial professional looking to integrate tax services. So you may say, I have a business, but I've always thought about adding tax services to my business. Now is a great opportunity for you. I just created a Revenue Diversification Academy where I show you as a business owner, as a seasoned professional, how to smoothly add tax services to your business. Okay, this is definitely a game changer for most of you looking to integrate tax service into your business and boost your income. Okay, so if you are interested, Let me put the link here if you are interested in joining with me. I am actually having a session right after this session via Zoom, okay, via Zoom. If you are interested in joining the class, okay, if you are interested in joining the class, let me find that link. I always have a situation with that link. Okay, here is the link here. So if you are interested in joining the session right after this, I have a private strategy tax session, whereas I will go over things with you. We won't be long. I'll go over a few things with you. If you're interested, if you are a professional, if you are a CEO, if you are a financial advisor, whatever your profession may be, and you have been thinking about adding another stream of income or diversifying your income, I have a great recession-proof business I want to share with you how you can add it to your current book of business by utilizing your same clients, okay? And we can go over that in this private tax strategy session, okay? So you'll click this link, go to bit.ly private tax strategy session, okay? Bit.ly private tax strategy session. Go there and I will put it in the comment section, okay? I will put this link in the comment section. So you can join that right after we close out this, okay? Right after we close out this, you can join, okay? So anyone have any questions? If you're watching a replay, just remember that you can also go and add that as well. So I'm excited, you guys, for you all to join me here on another live session of Integrate and Prosper. It has been great to be here with y'all on you all's lunch break. It has been amazing. I'm excited to share this information with you all today. We went over the 5 audit triggers before filing your taxes. Make sure you are not utilizing those 5 audit triggers, okay? Make sure we are safe, okay? So again, we're about to end. If anyone do not have any questions, we're about to close out today's session. It has been love, you guys. I really enjoy coming on here with you all, sharing this information with you all because I enjoy what I do. I enjoy sharing this information. I enjoy teaching it. And I hope you all enjoy receiving this information. Okay. So if you all don't have any questions, I'm about to get ready and go over to the other session via Zoom for the private tax strategy session that I should share the link with you all. If you're interested, just come on over there and join with us. If you have any questions, it's a very private session that you may be interested in. So I'll go over and I'll share some information with you to show you how you can integrate this recession-proof business with your current business using the same clients, okay? So you guys, that's all I have for today's session. So you all be blessed. We'll see you all next week. Bye for now.